The purpose of this video is to provide a brief explanation of how an income tax-free retirement strategy might look using the living benefits of life insurance. The type of policy I'm going to use is called universal life. You've probably heard of it. There are a few different types of universal life policies, but for this example, we'll keep it very general. In this example, you are putting money into a universal life policy. Before the money even gets to the policy, a small portion comes out for fees and expenses, just like any other financial product. However, the rest of the money goes into the universal life cash value, which is represented by the dark blue box with the dollar sign. Then systematically, the insurance company pulls out the amount of money it needs to pay the death benefit costs, just like term insurance. The small blue box represents the minimum amount the company says you have to put in to be able to purchase the policy. However, there is a bigger box, and it's the dotted box. This box represents the maximum amount the IRS says you're allowed to put into the policy. And generally, anytime the IRS limits what you can put into something, it's usually because it's really a good deal. A couple of important side notes to be aware of. If one of the limits are exceeded, the policy becomes what's called a modified endowment contract, and all of the money taken from the cash value becomes taxable. So you need to be careful when designing a policy to avoid this. And number two, the sizes of the boxes, meaning the amount of money you either need to or are allowed to put into the policy, are directly related to the amount of life insurance that is purchased. The more life insurance you purchase, the bigger the boxes. Many of you looking at this diagram will have two questions. The first will be, well, where does the income tax-free retirement come into play? And the second will be, what if I don't want to buy life insurance? Why should I pay for a death benefit I don't want? Let's start with the tax-free income. The difference between the small blue box and the larger dotted box is your accumulated cash value in the policy. If you withdrew any of that money, it would be taxed as ordinary income. However, the life insurance company allows you to borrow against that money at what is, in effect, a 0 to 1% loan. Because it is a loan, you do not have to pay income tax on the borrowed money. The loan is paid back at the time of death. However, because you are borrowing against the cash value only, the death benefit is still at full value and passes to your beneficiaries income tax-free with no restrictions, no required minimum distributions, and bypasses probate and wills. Oftentimes, $1 of tax-deferred money can purchase between $2 and $4 worth of income tax-free permanent life insurance for your beneficiaries. So not only have you provided yourself with an income tax-free retirement, your beneficiaries will receive 2 to 4 times the amount they would have received had you not purchased the life insurance. Plus, they will not have to pay income tax on the money that they receive, unlike an IRA. Let's look at the second question. Why would anyone pay for a death benefit they don't want? The reality is the life insurance policy is a financial vehicle to achieve a goal, just like a 401k is a financial vehicle to achieve a goal, and all financial vehicles have fees, the difference being how large they are and what you receive in exchange for the fee. Typically, an insurance policy will have less fees than a 401k plan, and unlike a 401k, with an insurance policy, you get something in return for the fee you pay, meaning the death benefit. If I have to pay a fee, I would prefer to at least get something for my money. You are also forcing your money to work twice as hard, providing a retirement income and a death benefit. Well, who is this type of program best suited for? It'll work for anyone, but it can be best suited for physicians, dentists, business owners, high-income earners, and those over 65 with funds in a tax-deferred plan, like an IRA or 401k that is earmarked for inheritance. If you have funds in a tax-deferred plan earmarked for retirement, when you die, your beneficiaries will have to take required minimum distributions starting in the first year of inheritance for the rest of their lives. They will also be required to pay taxes on those distributions at the current tax rate. However, if their inheritance from you comes in the form of a life insurance policy, there are no restrictions as to when they can use the money, and they receive it income tax-free. Now, this program can be especially effective for business owners. That's because most small business owners do not have a lot of retirement plan options, and most of the options available require employee participation. Many small business owners would love nothing better than to fund an employee retirement plan. Unfortunately, the funds are simply not available. Since life insurance is not considered a tax-qualified plan, according to the IRS, there is no requirement for the business owner to fund a similar plan for his or her employees. However, there is a second, more important reason why this type of program is especially effective for business owners. Many small business owners reinvest everything back into the business, and selling the business at some point, in effect, is their retirement plan. Once a business owner sells the business, where can he or she put the proceeds that will provide a tax-favored status? He can't use a tax-qualified retirement plan, a pension plan, a profit-sharing plan, or even a Roth IRA, because each of these plans have contribution limits, and if the contribution is not deposited in the current year in which it is offered, then it is lost forever. None of these plans are adequately suited to receive a large sum of money that could arise from the eventual sale of a business. However, life insurance not only provides a completely flexible plan in which the business owner can vary deposit amounts from year to year, it also allows the business owner to make up for previously missed contributions if cash flows improve in the future. Let's say the maximum contribution allowed in the insurance policy is $5,000 a year, but the business owner only deposits $1,000. With a Roth IRA, the other $4,000 opportunity is lost, but with an insurance policy, the $4,000 opportunity carries over into the next year. As a result, it can be structured to create a bucket big enough to hold some, most, or all of the proceeds from the eventual sale of the business. This allows the business owner to put their sale proceeds to work in a tax-favored manner while at the same time providing a tax-free inheritance for their loved ones. As a nation, we are about to go through radical financial changes, and you will need strategies that will protect you from higher taxes, lower benefits, and the ravages of serious inflation. I have the strategies that can protect you from loss and give you the opportunity to thrive with minimal risk during these difficult challenges. However, time is of the essence. These issues are fast approaching, and action must be taken soon. At some point, the programs outlined in this presentation may be eliminated. If our government follows history, those that already have them in place will get to keep them, and those that do not will forever miss out on the opportunity. Don't miss out on your opportunity. Call me today.